It's easier to get approved for an FHA loan, but it doesn't mean it's the right loan program for your specific situation. It also doesn't mean that it's time to jump in. So I want to break down what the benefits are, maybe some of the hurdles, and when you're better off waiting. And this video is not about homeownership. It's about clarity, because there's a lot of misinformation when it comes to FHA loans. And there's people that will dismiss them, not understanding how incredibly fantastic they can be. I'd love to hear what's the thing that you've heard about an FHA loan. I mean, drop it in the comments below, especially if it's a hurdle that's keeping you away from the loan product. All right, so let's jump in with the FHA Wins, because when this program is on, it's really on. So number one is credit score. If you have a credit score lower than 700, you should absolutely look at an FHA loan. And some people will say even below 720. Now I want to double click on that, because often people will think, let's just go with a conventional loan. Now, FHA will go all the way down to 500. It's going to be tougher to get a loan between 500 and 580, because in that credit score range, it is a manual underwrite with more money down, typically 10%. And a lot of lenders don't even do them. But if you have a 580, you can put down as little as 3.5% down. Now, conventional loans don't start until a 620. And you'll find that the credit scores often dictate the interest rates. And with a lower credit score, you're going to have a higher interest rate, all the way up until you get to about a 700, 720. You're also going to want to consider the impact that that credit score has on mortgage insurance. FHA has a fixed monthly mortgage insurance premium of 0.55%. Now, conventional doesn't. It has private mortgage insurance, and there's 6 different private mortgage insurance companies who look at credit score along with a couple of other characteristics in determining what your monthly premium is. And you'll find with those lower credit scores that the monthly premium can get higher, where an FHA will actually give you a lower monthly payment. So all in all, if you're looking at a 580 to a 700, 720, consider an FHA. Look at them side by side. If you're 580 to 620, conventional's not even on the table. Another benefit specific to credit score is FHA only requires that you have 1 credit score. It also allows for no credit score, where we can create non-traditional lines of credit, giving you that ability to prove that you're able to carry that mortgage. All right, let's talk about one of the other benefits that I love FHA loans for. A lot of times you might find that the borrower can't qualify on their own, and they need a co-borrower, a parent or a sibling, an aunt and uncle, grandparent. And with conventional loans, a first-time home buyer can put as little as 3% down. But if you have a co-signer on a conventional loan, you're immediately bumped up to 5% down. On an FHA loan, you can stay with 3.5% down, even with that non-occupant co-borrower. That can make a big difference, and we've used that a lot where somebody might not have that extra 1.5% down, and we've moved them from conventional to FHA. Another win for FHA is multifamily. I can't tell you how often I'm talking to borrowers in today's environment with higher prices and higher interest rates about co-living. This is a big thing right now for people to offset the affordability issues that we've seen in our market. Well, if you're buying an opportunity that might be a duplex or a triplex or a quad, a 2, 3, or 4 unit, oftentimes you have to put more money down. Now, conventional just rolled back, where they are now allowing you to put 5% down. FHA allows you to put 3.5% down. That's a big benefit, especially as you get into the higher purchase prices with those multifamilies. And I can still use the rents on the other units that you're not living in to help you qualify for a higher purchase price. Another win for FHA is if you have credit bumps and bruises. Now, I don't want to land here too long, because if you have credit bumps and bruises or a really low credit score, I might question if you should be waiting to purchase a home at all, especially with higher prices. That might give you a higher interest rate, which of course is going to impact your monthly payment and affordability. But if you've turned things around and you've got the incomes to support it, and you're 3 years out of a foreclosure or short sale, or you're 2 years out of a BK7, or even 1 year into on-time payments with a BK11, all of those allow you to qualify for an FHA loan. I mean, that's a win, especially for somebody who maybe bumped into a situation that they didn't have full control over, that put them into a situation where they couldn't buy a home. Otherwise, FHA is going to open the door for you. All right, here's one more win, especially in this market. Right now, buyers have an advantage to negotiate seller credits. So conventional loans have seller credit limits based on the amount of money down. If you're putting 10 or less than 10% down, it's limited to 3% seller credits towards the buyer's prepaids and closing costs or rate buy downs. If you're putting between 10 and 25% down, it goes to 6%. On FHA loans, you can put as little as 3.5% down and still get 6% in seller credits. I've used this a lot to help buyers who are using an FHA loan really buy down that interest rate or pay all of their closing costs and still support a lower interest rate or a temporary rate buy down. All right, here's the last win. I know I had a lot of them. I actually really love FHA loans for the right scenario. And here's the last one I'm going to talk about today. It's with condos. Right now, we're bumping into a lot of condominiums that are not getting Fannie Mae or Freddie Mac approved because of the wind and hail deductible. And there's a lot of other reasons why a project might not get conventionally approved. But if it's an FHA condo and it's on the FHA approved list, it's good for 3 years. Another thing is FHA doesn't look at the wind and hail deductible. So if I have a condominium project that's the reason why it's non-warrantable, I can get a single unit approval, even if it's not already on the FHA approved condo list. This has been a big win because we can actually do them in-house, and I can get them closed and to the closing table in as quickly as 3.5 to 4 weeks. Now, if for some reason that condo project doesn't check all the boxes and we can't underwrite it in-house and I have to send it to HUD, well, the benefit on that one is it might take a little longer, typically 6 weeks, but then I get the whole project approved. And I've had a lot of listing agents who have loved that because then they were able to not only get that seller under contract and that buyer to the closing table, but also other sellers in that same condominium project. So absolutely, that might literally be the home run. On the flip side, here's a couple of things that you need to know. FHA is absolutely a stickler when it comes to the 2 years work history. And I want to dive into this a little bit because it's going to affect you in a couple different ways. If you're self-employed, sometimes on a conventional loan, I can get a 1 year. FHA, absolutely always 2 years. Variable pay, absolutely always 2 years, unless I can actually show and document something that shows a salary increase or an hourly increase. I might be able to go variable pay with a higher amount, but typically we're going to be looking at 2-year averages. Also, if you've been working and say you went on maternity leave or you had another leave of absence, or maybe you just stopped working because you needed a break. It happens. If you've been not working for more than 6 months, you need to be back on the job for 6 months at a minimum, and I need to procure a 2-year work history before your gap of employment. This is kind of a big deal, but I can use school as part of your 2-year work history, meaning as long as I can get a transcript, I can actually add the school history on top of your work history. So you could be just a day into your new employment and still get an FHA loan. Another bit to know about is if you happen to be a job hopper. FHA is not going to like it if you've had more than 3 jobs in the last 12 months. They can kind of be a stickler on this. If you've had more than 3 jobs, we're going to be looking for some sort of compensating factor on why that was, and they're going to be looking for those wages to be increasing with each new job. Now, the last thing to pay attention to with FHA, and this might even roll into some of the reasons why you might wait, FHA has an upfront mortgage insurance premium. It's 1.75% of the loan amount. Now that can be kind of a big deal, especially if you're only putting 3.5% down. Half of that is going to be taken from your equity. So if you put 3.5% down, it's not going to be an additional 1.75% charge to you. It's simply going to be added on to your loan amount. And right now, we're seeing lower appreciation amounts. So whereas we might have been seeing 3.6% historically nationwide, even here in the Denver market, we might have been seeing closer to 6 to 7% a year. Right now, we've seen flattened appreciation. So if you're not planning on being in that home for a minimum of 5 to 7 years, you have to take that into account, that 1.75% is going to be rolled onto your loan amount. And that monthly mortgage insurance that we talked about earlier, that was a win for lower credit scores, it doesn't go away. Where conventional loans, eventually mortgage insurance can roll off, FHA monthly mortgage insurance is for the life of the loan. So my not good list is a little bit shorter than my win list because, again, for the right person, an FHA loan can be a home run. Now, conventional loans have a lot of other wins, and I'll talk about that on another video. But for today, when should I wait? Nicole, you talked about the wins, you talked about some of the hurdles. I'm ready to buy. Should I be waiting? You might want to wait if you've got one of those lower credit scores. How much is it going to impact your affordability and your interest rate? Is it something that you can tackle before jumping into home ownership? And especially if that lower credit score is due to higher debts, there's nothing worse than jumping into home ownership being house poor. So making sure that you have the reserves, making sure that you don't have an abundant amount of debts that's going to weigh you down after home ownership, and that you've got a credit score that's going to give you an interest rate that effectively is going to give you a monthly payment that is going to make that home affordable. I mean, no one wants to or should be pushed into home ownership because they should. Nobody should be a homeowner. If you're ready financially and emotionally to look at purchasing a home, my team would love to sit down with you because FHA might actually be the perfect tool, but you don't know unless you do a side-by-side comparison, which we do with a lot of our clients. And if you're not ready and you're just not quite there yet, then wait. It has to be an all-in feeling. In the meantime, build up your credit score, save more money, and prepare yourself for home ownership because that is the win. Nicole Ruth with Movement Mortgage, it's been a pleasure, and I look forward to seeing you on the next video.